The Dow closes at an all-time high, but without the S&P or NDX. And Bitcoin's crash quantified. Don't miss this, all on today's REKTelligence Report. As a friendly reminder, everything in today's show is for informational purposes only. There is no investment advice given. All right, let's get into the show. Hey everyone, welcome. I'm Dave Bush, and this is the All Markets Report, where I quantify across asset classes with an eye to the week ahead. And what a week last week was. A lot of question marks raised for a lot of different reasons. I'm setting out this week to answer several of them across equities, crypto, and one in commodities. All that ahead, so let's get right into it. This week's first key theme is the Dow Jones Industrial Average making a new all-time high. You probably heard it on the headlines. And yes, while the Dow is the least significant of the major averages in many respects, how has the market as a whole performed when the Dow makes a new high and yet the S&P 500 does not? The NASDAQ 100 index also doesn't confirm it. Is there trouble in paradise? I'm going to quantify that. Secondly, stock market breadth. Is it all over for the momentum factor? I spent last week's Edge report focusing on the SaaS, software as a service, or large software sector, and quantifying a lot of names in that sector. So if you've seen it, you have some perspective, but I'm going to step back and just look at market breadth. Is it healthy? What is the momentum factor right now? Value factor, how are these interrelated? I'm going to take a look at all that. Next, Bitcoin extreme measures. If you have any interest in Bitcoin at all, don't miss this section. This is the largest part of today's report, and I quantify the extreme price action we've just seen in a few different ways. Lots to that section. Stay tuned. Lastly, silver. I'm going to comment on the down 30% inside 7 sessions. Is this a major buy? Is this a sell? Is this something else? I'll start with the stock market. And as mentioned, the Dow just made a new all-time high, closing above the whole round number of 50,000 for the very first time, right at the end of the week. And I'm old enough to remember when the pressing question was, can the Dow close above 10,000? Obviously, it's been a minute, and we're 5x that now. But this happened without the S&P 500, no new high for the NASDAQ 100 or NDX. So let's quantify it. And using a 10-day hold, very short term, you can see that the total P&L here is positive, 53.7 and change percent. There obviously is some drawdown. It's nothing crazy in my view. And the total trades or instances of this happening from 1975 to the present are 208. So this is not uncommon. It's not a rare setup when this happens. The profitability or hit rate is 57.21%, so north of a coin flip, of course, and profit factor is an unexciting but definitely above one figure of 1.314. So I'd love to see it almost 2 or above 2 for a great profit factor. For those who need a refresher, profit factor is the sum of total profits divided by the sum of total losses. And you can see this is 1.3 times the amount of losses. So that is obviously positive. Let's go out to 30 days and we can see the total P&L does rise here, but overall this looks much the same. Sure, there are fewer instances because we're holding 3 times longer in this case, but the hit rate's about the same, profit factor is roughly the same, drawdown's a little worse, not much different from 10 days to 30 days. Let's move out to 60 days and what a strikingly different picture here. Look at that equity curve, 75 total trades from 75 to the present, 1975 to the present, but we have 75 instances. And the total P&L over 500%, a big jump up. Drawdown is reasonable here. Profitability or the hit rate is better than 2 out of 3, 72%. And the profit factor, not quite 3, but 2.84. That's an excellent profit factor, as I just explained. So the 60-day window here, looking very good historically. Let's go out to 90 days, and we see certainly a respectable equity curve, but everything dips a little bit. Total P&L is a little less, drawdowns a little bit greater, total trades 61. The hit rate is just north of 2 out of 3, so it's definitely good, 68.85%, and profit factor just south of 2. I mean, decent, just that 60-day window so far looking the best historically, and go out to 180 days, and again, looking excellent. Total P&L 600%, right on the nose. Drawdown, max drawdown 35.65%. Total trades 38 over this roughly 6-month window. Hit rate 71 and change percent. Profit factor 2.89. Definitely excellent. Not a lot of extra benefit historically in terms of these stats holding roughly 6 months versus 60 days. So that's kind of interesting to consider. Keep that in mind. And let's move on to another facet of the market now, breadth. I'm going to discuss an interesting dynamic right now in the market, which is momentum versus value, or growth versus value, if you prefer. And then we'll move into breadth, and naturally it's all related. And it's very interesting right now. So here is a chart of the Vanguard US Momentum Factor ETF divided by the Vanguard US Value Factor ETF. And when it's rising, it means momentum is in favor, and when it's declining, value is in favor. Now, it's a ratio chart, so there are different ways to interpret it, meaning it could be when it's rising that momentum's in favor, or simply that value is really underperforming, and vice versa. But you can see on the right-hand side of the chart, we are quite off the highs, and we just had quite a pullback in this ratio chart last week. This indicates that momentum is either sliding or values in favor, so we'll get a little bit more insight into that momentarily. Let's now look at the S&P 600. This is a small cap index value ETF, which is SLYV, and this just broke out last week. You can see this is actually trading at an all-time high. Obviously, I don't have a ton of data here, but it is at an all-time high. So small cap value stocks doing quite well. Let's look at small cap growth stocks, different ETF. And you can see also did quite well to end the week, right? That was a good day on Friday. It's just not at a new high. So you can see here in the small cap space, there are growth stocks doing quite well. They're just not quite doing as well as the value stocks in that same segment of the market. Now, what about the top of the market? Here is the S&P 500, and we're going to look at breadth. And one way to do this is to look at stocks above specific moving averages. So I have 4 here. Stocks above their 20-day moving averages. 66.5% of the S&P 500, those stocks are above their respective 20-day moving averages. Short-term average, that's pretty good. Stocks above the 50 MA, 67.7%. Stocks above the 100 MA in the S&P 500, 66.7. That's a perfect 2 out of 3. Stocks above their 200-day moving averages, 67.1. It's statistically almost the same across the board. Breadth remains strong even at the top of the market inside the S&P 500. So the market overall appears strong. The Dow just made a new high without the SP and NDX, and nevertheless, the stats look good going forward. Equities remain in favor more broadly. Time for crypto, and this is really going to be about Bitcoin this week. It was the story, it's the driver in the space. Most of the money in crypto is inside of Bitcoin, even though it's less money now. Is there opportunity here? Let's find out. So the first way I'm going to define the Bitcoin price action is down 30% or more inside of 20 days. This just happened. You can see that white box at the bottom of this chart indicates that it actually dipped or closed a little bit greater than 30% down inside of 20 days. And let's see what this looks like over 10 days. So once this condition hits, exit 10 days later, that's the test. From 2011 to the present, it is profitable. Total P&L 48.4%. Drawdown is very large, and that is more concentrated in the early years. You can see the histogram bars are pretty negative in those early Bitcoin adoption years, but nevertheless, the drawdown is very steep. Total trades 25 over all of this time. So the average trade here is not anything to write home about. 25 trades, 48.4% total P&L. Profitability or hit rate, 64%, pretty decent with a 10-day hold. And profit factor is just slightly north of 1. So it is profitable, 1.211, but nothing to write home about in terms of profit factor either. 30-day hold, same condition. Greater total P&L. There are 18 instances and still a very steep drawdown. You can see the hit rate is 55.56%, so it dipped a little bit with a longer hold time of 30 days. And profit factor, however, is improved, 2.012. It's respectable. So it's not a smooth equity curve. This is not a system I would trade. But again, I'm gathering information. I want some perspectives. As I often say, I want to see different sides of the diamond. This is the first facet I'm looking at. Let's go out to a 90-day hold, and I've got total P&L now at 120.5%, 13 instances. Drawdown is insanely huge, 82 and change percent. You can see that is in 2011. And the hit rate, 53.8 and change percent. Profit factor, 1.869, definitely respectable. And you can see the equity curve has done a little bit better in recent times under this condition. Now, 180-day hold, total P&L jumps to 223%. There are only 10 instances, so the average trade improves. Drawdown is still massive, mostly from 2011. And the hit rate is a coin flip, 50%. 5 winners, 5 losers historically. Profit factor, very nice. So you can see, even though it's a coin flip and drawdown can be very steep, the profit factor is well above 1, 2.64. Definitely decent. Not very many instances, but these are extreme conditions. So Bitcoin also fits this criteria. It's down, not quite 50%, but 45 and change percent inside of 120 days. What does this look like historically? Well, there have been 34 instances of this. Hard to believe, but total P&L, 154 and change percent. Drawdown is surprisingly not as steep as one would expect, 44 and change percent. Again, 34 instances. The hit rate, 61.7 and change percent. And profit factor better than 1.5. So that is decent. And this is done fairly well in more modern eras, the more modern era as opposed to the early adoption days. Let's go out to a 30-day hold. This is actually a respectable looking equity curve. We see total P&L 339 and change percent. Drawdown pretty steep. Looks like, again, 2011 is the culprit there. Total trades at 17. It's just north of a coin flip at 52.9%. And profit factor is 2.3, very respectable. Let's go out to 90 days. And total P&L, 354 and change percent. Drawdown still steep, but not as bad. Total trades is very few, 9 now. And the hit rate is south of 50%. So it loses more often than it wins under this condition with a 90-day or roughly 3-month hold. Profit factor, however, is excellent, 3.824. It's easier to have a high profit factor with fewer instances. If you've done any testing and modeling, you know that. But nevertheless, it's certainly a good sign. Let's go out to 180 days, and we see total P&L 803 and change percent. Drawdown roughly the same, 8 instances now. 50-50 odds, and profit factor 2.33. Certainly looks good for very few instances. So once again, overall, this way of looking at Bitcoin is again showing an edge that is a positive one. Now let's look at another thing that I love to look at, which is the stretch percent. This is an indicator I created which measures the distance of the simple moving average, a 20-period moving average, so a 20-day moving average in this case, and the distance to price. Obviously, price is below its 20-day moving average for Bitcoin right now. And in fact, it was stretched more than 30% at one point intraday, but by the completion of the candle, it was stretched minus 25%. It was less than or equal to minus 25% below its 20 MA. So here is a 10-day hold, total P&L, 1,349 and change percent. Drawdown, pretty reasonable for Bitcoin at 44 and change percent. 19 instances of this, 2011 to the present. Profitability, 84.21%. And again, to be clear, this just set up in Bitcoin. The profit factor here over 19 trades is 6.596. So this reversion setup is quite powerful, at least over a 10-day hold. We'll see if it holds up over longer exit times or hold periods. But part of this is why I call it the stretch. There is a rubber band aspect. It's very hard to get that far below a 20 MA, even for Bitcoin. It doesn't happen every day. In fact, again, just 19 instances in the last decade and roughly a half. Let's go out to 30 days now, and we can see total P&L 2,000 and change. Drawdown, pretty reasonable. And why is drawdown a little bit more reasonable under this condition? Because once again, it's already drawn down. These stretch percent readings are occurring when the market is very distressed, right? So it's already in drawdown. And so the drawdown, once you open a trade, or at least a hypothetical trade under these conditions, sure, it can still extend, but it typically is not as bad. 17 instances. The hit rate is 70% and change. Profit factor 11.168. Over 17 trades. It's pretty impressive. It's a good equity curve. Let's look at a 90-day window. Total P&L 4,655%. Drawdown does steepen here with this 90-day window. And you can see mostly, again, not exclusively, but mostly due to the early 2011 drawdown. 13 instances or trades. The hit rate 69 and change percent. Profit factor still holds up 14.2 and change. Fabulous. Let's go out to 180 days, 11,650 and change percent. Drawdown is huge again here under this roughly 6-month window of time. And again, it's from the early adoption days. The hit rate 72 and change percent. Profit factor has stepped back, but the total P&L is much larger. 7.51 profit factor. Really looking excellent. Now, I want to look at a 1-year hold time, but I'm going to do it a little bit differently. I'm going to look at each of these queries or tests that I've run and just look at the trades briefly with a 1-year hold time. So you can see very bottom of this chart, these are the older instances. So you can see here from 2011, the worst single trade under these conditions, I believe. Yes, that's true, 65.95% negative. We can see also an early trade that's positive 43 and change percent from 2013, a modest loss 2013. If you look at 2014, entry and exit in 2015, if you look at the more modern era, it's still going back a ways, but you can see negative 22.8%, a positive 109 and change, negative 24 and change, positive 88 and change, positive 109 and change, positive 73 and change, negative 8.39, it looks like, percent. That was a loss in the bear market of 2022, and a more modest gain of 13.6, in fact, which is currently open. So that's not even a closed trade right now. So interesting. Again, the worst losses in this case are concentrated in the early years. Now, let's look at down 45% or more inside of 120 days with a 1-year hold. And you can see in this case, the biggest gains are from those early years when it was even more volatile. And you can see a massive gain of 168 and change percent that was closed out in 2012. You can see almost 500%, just astounding. That was closed out in mid-2014. And then you can see more recently losses, 33.3%, negative 25 and change, negative 34 and change, and then a couple more recent winners. But this is almost the opposite. You're seeing the best performance in the early days under these extreme conditions and less impressive or even poor, arguably, performance more recently. Now let's go to the stretch percent being at least 25% below its 20 MA with a 1-year hold. And if you go to the early years, we can see negative 59 and change percent loss. And you can see an astounding gain, 238%. See another giant one from the early years, 58 and change percent gain, negative 5 and change percent. Then it's positive 60, positive 109, positive 181, positive 88, positive 109, positive 73, negative 12 and change, and then positive open, but positive 13.4%, which just triggered the other day. So again, in the modern era, if you will, this last set of conditions or query is pretty strong. So I want to look now at all of these in a new way. Here are all of the studies that I've looked at, the 3, with a 10-day hold, and I'm just going to go right down to the bottom. The average trade across all of these studies with a 10-day hold is 25.84%. Let's go to the next one, which is 49.83% over 30 days. That's the average of these 3 studies. Let's go out to a 90-day hold time, and the average trade across these studies with the 3-month window is 135 and change percent, hit rate 55.84%, and go out to 180 days, 394% average trade, hit rate again 57.58%. That ballpark is pretty solid. Total return, of course, is quite impressive with the 6-month-ish window that we're looking at. I want to look at a 1-year hold, but let's get rid of those early adoption years. So 2014 to the present. Now, study number 2, which was down 45% in 120 days, it collapses from being the best performer to a losing edge or strategy or logic, negative 37.64% when the early Bitcoin years are excluded. So it really reveals that the entire edge came from those early years, and I pointed that out a bit earlier. But it's striking to see the numbers there. Study number 3, which is the stretch percent, actually improves in modern markets with a 75% hit rate and 42.35% average per trade, proving it's the only strategy that works consistently across different Bitcoin market regimes, or at least the only one that we looked at today since 2014. Remember, we're taking out 2011, we're taking out 2012 and 2013. I don't even look at the 2009, 2010 because the data either isn't there at the very beginning, of course, or it's very sketchy in the late 2010 in my view. All right, let's look at study number 1, which was the down 30% in 20 days. This produced a dismal 23% hit rate 2014 on, with a negative 22.48% median return, suggesting panic selling continues after fast crashes, while slower grinds mark true bottoms. The June and July of 2022 entries produced exceptional gains, 131 and change percent, 42 and change percent, suggesting these strategies aren't dead, but may require extreme capitulation events like 2022's crypto winter to generate a true edge. And bottom line here, excluding the early Bitcoin years reveals that intense dislocation, which is how I view the stretch percent at that level, is far more predictive than extreme crashes for a 365 or 1-year forward return. Most strategies degraded significantly in mature markets, 2014 to the present. Only the stretch percent metric maintained and even improved its edge. So it's a mixed picture, but remember, all of these are positive. You look at modern markets, though, 2014 to the present, and that starts to bifurcate. So there's a lot to chew on here. Again, my favorite metric is that stretch percent. And last thing I'll say is the stretch percent has that strong reversionary property. We saw that in the stats. It doesn't mean that the market can't hit a lower low after that stretch percent. That stretch percent is often at major lows. Doesn't mean it's necessarily at the cycle low, which might happen with less impulsivity to the downside. All right, folks, that's it for the crypto update. One more right ahead. Last but certainly not least, time for a commodities update. And I'm going to turn once again to silver because of this. Down 30% inside of 7 sessions. Ouch, quite a haircut. How many times has this happened before? And what does it say about silver going forward? So first of all, very few instances, only 2 closed instances. At the bottom, we see the first, which is an entry in April 1980, an exit in May of 1980. And this was a loss of negative 21 and change percent. You go to number 2, which was during the pandemic, the start of it. An entry in March 2020, an exit in April 2020, positive 27.2%. And essentially there, with the 2 instances, very rare, it's basically a wash, right? It's noise. We just don't have data to conclude anything other than there is a new instance which is underway, right? This just met entry, if you will, and there is no trading since. So you see that 0%. So this is very inconclusive. rare territory for silver, just like when I pointed out in a past report that it was very stretched above both its 20-day moving average as well as 20-month moving average, and it pulled back from those levels in both cases. Thanks for watching, everyone, and this was a long one. Thanks for hanging in there. I hope there are nuggets that you can take and use to inform your own trading and investing. That is the point. And folks, I will see you in the next report, which will be out Thursday morning, the Edge Report. Until then, have a great week. Talk to you soon, and cheers from the Caribbean.